We got another deal here. Same as all the others. I'm going to do first impression, walk you through this deal, walk through my red flags, my yellow flags, my green flags, as well as walk you through the numbers so you have an idea of what this is going to look like if you wanted to structure a deal and see what cash flows and everything like that look like. So let's go ahead and dive in here. We have a interior commercial interior contractor, outstanding reputation based in Richmond, VA, which I imagine is what this RVA is. Let's take a look. Interior contractors, really not a bad industry to be in. Asking 3.75, cash flow or SDE 1.15, gross revenue 5.5 million. I would say this actually potentially is close to reality in terms of like an SDE versus what would be normal cash flow, like after you pay an operator, things like that. There's a good chance that this is actually relatively close because it'd basically be about 20%. I would imagine it's not running that efficiently, maybe like 15 to 18%. So this is probably only a little bit off from what actual kind of cash flows EBITDA would look like. That's bankable. What we have here 20 years in business, 21 years in business, definitely not bad. So there's more than enough reputation built here that they're probably getting jobs on referral and word of mouth and things like that. Generally, with a lot of these contracting companies, you really need to be +7, +8 years to start getting that reputational feedback where you're just getting you're getting the phone ringing effectively all the time. 10 plus years, it's decently established. 20 plus years, I mean, it just rings like clockwork. So overall, not bad looking so far. Let's see, Richmond, VA area. It's an interior commercial contractor with a focus on office, industrial, warehouse, and retail buildouts. So they have a relative breadth because certain areas like retail has their high periods against industrial, against office. So I'd imagine they're trying to cover their bases by not really having slow years based on economic events and things like that. Wide range of projects. They do drywall and ceiling repairs as well as full space conversions. 30 years. Did I get that math wrong? 25 plus. Yeah, sorry. Almost 30 years in business. Yep. Good reputation for precision, professionalism. All good. 2024 financial performance 5.562, 1.15 in SDE, seller discretionary earnings, which to be honest is not really the same as cash flow. And it's also not the same as EBITDA. So that's why I talk about, potentially this is close to. And when we go through the numbers, I'll walk you through. This is one we'd probably put a minimal discount on cash flows or discount on SDE on to get to a more realistic number because I think the margins are going to make sense. They're going to probably line up. Whereas, if they were saying this is maybe 1.5 or almost 2 million, that's too high of a margin for a commercial contractor. They're making too much there where their clients would be pushing back unless they flat out stated somewhere here like they're like the most expensive in the space, most luxurious, all that. So this one's going to be relatively minimal discount, I imagine. Asking 3.75, looking for an asset sale. That's to be determined. Obviously, it's ideal for a buyer because you get a ability to depreciate. But when there's contracts involved, especially when it's long project bases and everything like that, you have to determine this based on what's going to disrupt and impact day to day because you can always get election bases and all this other stuff to get the same effect tax wise as an asset sale. However, what is going to directly impact your ability to get new clients, fulfill on existing contracts, and keep the business's cash flows going is what will determine whether it's an asset sale or a stock sale that you do. And that'll also further impact to just ensuring that it all makes sense and there's nothing like legal liability there. And then you also get good reps and warranties and everything like that. So this it's probably too early to tell whether that makes sense. 335,000 in fixtures, furniture, and equipment seems kind of low for a commercial company, but I guess because they're interior, they probably don't have heavy duty equipment. Like if they were doing full build of infrastructure or full build of a structure, so maybe that's in line, and it does exclude inventory. So maybe that's about right. You'd have to really check the age of vehicles here, whether this is what would be post depreciation book value or just raw asset value. So I'd imagine this is including depreciation and kind of wear and tear on the vehicles, but you'd probably want to check age because this seems on the lower end. I'd kind of more expect 400,000 or 500,000. Inventory 200,000 seems about right for 5 million in revenue. I mean, I'd almost even say potentially that's high end, but maybe they're including jobs currently being worked. My expectation is that this would be mainly things that they would keep on hand beyond standard jobs. So maybe it's like material excess, or maybe it's just nuts and bolts and things like that that they typically have to deal with. Any of those types of elements. Uh, Commercial contractor, LLC, general contracting, class A. So there is licensing involved here that you're going to have to be aware of. So, big thing to investigate, more of a yellow flag. Is the owner the core qualifier for this license? How easy is it to get? Are there current other employees that can take it on that have the experience to qualify? And if all of those are kind of no, 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 no in terms of ability to easily transition, then you're going to have to look at, is there a RMO, a responsible managing officer, basically a license qualifier that you can easily get a hold of to step in? And what's that going to cost you in terms of cash you're going to have to give them for the size of company? Let's see. Consider building a website. That kind of says it all there in terms of growth opportunity. So again, this kind of ties back to a few of the videos where I mentioned the brokers like to highlight things like, oh, it's all referral business or it's all word of mouth, which for some buyers, they look at that and say, yep, that's awesome. The reality is, especially someone who's run multiple companies before, once you see something like that, you generally say, okay, that's not great. That generally means if I want to go and drive this from 5 to 10 million in revenue, I don't have a base to work from. I don't have any type of data to leverage. I'm going to have to spend a bunch of money, probably a lot more than the 5 million in new revenue that I'll make, trying to figure it out. So building a website, having a LinkedIn presence, it pretty much tells you right there, they're getting some type of direct referral business, direct inside track, or direct response. Now that said, they may also just be doing a lot of bidding, and if they're doing bid spec and that's how they're getting all their jobs, nothing wrong with that. That is actually predictable because you can always just go and bid more jobs, bid more jobs, bid more jobs. So interesting one, kind of again, yellow flag to be determined. Hiring for a dedicated sales and project management team can help expand capacity. So it gives you some idea for structure. This one's a bit of a yellow flag for me because I have to really understand how in depth the owner is currently handling these two responsibilities, because that's basically what this is saying, is the owner is the one handling this. And how much extra overhead is this going to be? Is it really going to be two separate people? Is it going to be one kind of, I'd almost really say CEO level person who's going to drive oversight? What is that going to have to look like? If you're looking at two new folks, so a sales head and then a field manager supervisor, I mean, you could be talking 200, 250 grand in added cost, right? So that brings this 1.1 million down, which is probably more like 8 to 900,000, brings it down by that extra 200 and some thousand. So we're probably going to take that into account when we go through the numbers and calculate here. Then let's look here. So 9 employees, very, they must be using subcontractors. That's very small for $5 million in revenue. Or they just have a crazy ratio of revenue per employee, which I would doubt. I'm sure they subcontract things or just have contractors that they use on a regular basis. 2,000 square foot office space and a 2.5 acre property with 4 large storage buildings. This seems like overkill if they only have 300,000 in equipment here. So there's a good chance you can really downsize this, but the owner owns the property. So if you can lease that entire thing for $2,500 a month, that's phenomenal. That's a great deal. My guess is this is probably going to increase, or if he's really not using it, I mean, you may get lucky, you may be able to keep that. But let's see, 6 million in projects and books. That's good. So they basically got a year booked out. Revenue increased to 7 million and 1.8 million left to bill. So, I mean, it's basically on track for a higher revenue range. So they're in growth mode. So one thing to expect there is, I mean, kind of expect you're probably going to have to do some give in terms of what your structure is going to look like. Considering it's a growing company, they're probably netting a good amount on that. Owner retiring as needed and negotiated for training and support. Exactly what you want to see. That's perfect. And yeah, I mean, overall, it's looking quite good. So let's take a look at the numbers here. I'm just going to pull some of these numbers to plug and play into our calculator here. So we got purchase price, 3.75 million, revenue at 5.5 million, cash flows at 1.15 million. And so what we're going to do here is based on these inputs, we're going to do a cash flow discount of 15%. I think that's reasonable to turn this SDE into actual cash flow or a normalized level of EBITDA. Working capital, I'm going to leave this, I'm going to leave it empty because I'm going to assume you're going to structure a couple months working capital and there's probably retainage and things that you might be taking over. So I'm going to leave this as zero, assuming that it would be negotiated as part of the deal. Operator costs, though, I'm going to put as if we're kind of placing two folks, right? So a salesperson and a field supervisor, 120 grand a pop, give or take. And I'm going to assume you're putting your own 5% into the deal to make it work. So 5% down against some seller finance, and then the rest of the deal on SBA. So let's calculate and see what we got here. And so let's talk through some of the top level bits here, just so you know what you're looking at. So key assumptions that we generally bake into this calculation, this formula, is 10.25% interest rate. That's just, it's prime plus 2.75%. It's the high end of where SBA will go. We just assume it because you can always negotiate down, but if it's a tighter deal, lenders will probably push there. Amortization over 10 years. Due diligence and closing costs, we're assuming 4% of the total purchase. So if you're buying at 3.75 million, we're assuming 4% of that is in addition your due diligence and closing costs. And then buyer cash injection, 5% of the total project. So what we have here before I run through this table, 150,000 in assumed closing costs and due diligence, 195,000 injected in, and then we've discounted our cash flows, this 1.15 million, by 15%. So we have three scenarios here to break down. So we have if you get a 10% seller note, if you get a 20% seller note, and if you get just whatever it takes to get to a 2 times debt service ratio. Debt service ratio meaning the amount of debt coverage from your cash flow. So if you cash flow 200,000 a year, your debt payments are 100,000 a year. That is a 2 times debt service ratio. It's basically your cash flow 200,000 divided by 100,000 equals 2. So what we're looking at here at a 10% note, you're asking the seller for $375,000 as a seller finance note. You have 3.3 million as a loan. Annual debt service is well over $500,000. Debt service ratio 1.38 times. This would meet a lender minimum, but realistically, it wouldn't meet a reasonable minimum. Gives you very little wiggle room if shit hits the fan, to be honest. Now, that said, this is also assuming that you are placing in a salesperson and a general manager or field supervisor. So your cash flow to yourself after those is 200,000. This would probably be out the door. There's no way that's going to be within comfort to get a deal done. 20% seller note, though, if you ask for 750,000 in seller finance, just under 3 million as a loan, 473,000 in debt service payments, still high compared to your cash flow, but it's starting to get within realm. Debt service ratio at 1.5 times, not bad, not amazing, but not bad. There's going to be many folks who will do a deal like that because, it's well above what they see as lender minimum. The way I look at it, you got 50% wiggle room within your cash flows before stuff gets really dire. Really, you only got like 25% as a lender sees it, but you generally got 50% before you really have issues. So it's not bad. And you can always obviously step into one of these roles yourself too, pull back another 120, 100 plus thousand. But even after that, you're left with $263,000 post cash or post debt service cash flow. So if you were to step in for one of those roles, maybe you step in for sales because you don't want to be in the field. Call it 100, 120 grand. You add on to this, you got 380,000. Debt service ratio goes up a good bit. But this would kind of be more the scenario that we would look at least as a starting point, is 37% seller finance, about $1.4 million. 2.1 million is a loan amount. $368,000 is annual debt service, 2 times debt service ratio, and cash flows at 368,750 with the 2 key placements that you're looking at. Now, again, this is assuming that their SDE numbers are 15% above where their real EBITDA, normalized EBITDA is. And it's also assuming that you're going to roll all your fees and put down 5%. But somewhere between these two is likely where you would want to go. Some maybe 25% seller finance, or even as high as 30% if you can swing it. That gives you a lot of wiggle room, but it still gives the seller effectively 2.5 times cash on close of their net cash flows. And debt service ratio is between that 2 and 1.5, somewhere in the middle, where there's still good wiggle room for if shit hits the fan. But you have, at least as they stated, over a year of new revenues already locked in. So it's an interesting deal nonetheless. It's already somewhat decently structured, does need some adjusting. And obviously you have to really vet through this cash flow and SDE number to really understand it. But not a lot of yellow flags, no red flags, or at least what I saw. So an interesting little deal. If you're on YouTube, go ahead and hit subscribe, hit the like button as well. It'd be absolutely appreciated. If you're on Facebook, go ahead and jump over to YouTube, hit subscribe, but also feel free to hit the like button on Facebook and comment down below to let us know if there's any other deals that you're looking at that you want us to review and do a video just like this.